So there's two types of recessions. There's a classic disinflationary one where it's negative. It put downward pressure on demand and prices. Some percentage of people lose their jobs and they have very negative consequences from that. But the majority of people don't lose their jobs and are relatively unaffected. Maybe they get a little bit more nervous around their jobs. Maybe they get lower raises that year, but they're relatively unaffected. Then there's the more inflationary type of recession where the release valve is not really unemployment, it's debasement. And this is more common in emerging markets where, the currency gets cut in half relative to the dollar. Everybody has more pain when they're buying anything, especially that's imported. I experience this when I go to Egypt. My family there, and friends there, they all report that it's harder to buy a car than it was, 3 years ago. It's harder to buy a computer than 3 years ago. All the prices of everything are up, even though it's not really like this unemployment cycle. And so basically, when you're running really hot fiscal in a recession, you can dampen how disinflationary it is, and you can dampen the unemployment to some extent. But then instead, it comes out in debasement and inflation, most likely. In general, we probably expect to see a little bit more stimulus out of the Trump administration. It's generally a little easier for them to, I think, to get their tax cuts through. Um, and then we could see tariffs. So it could be slightly more inflationary in that regard, but there's case to be made that either one is inflationary.
Recessions come in two main forms: the classic disinflationary type, characterized by reduced demand, lower prices, and some unemployment, and the inflationary type, where the pain is felt more broadly through currency debasement rather than job losses. The latter, often seen in emerging markets, impacts affordability for imports and daily necessities, as seen in examples like Egypt. Fiscal stimulus during such periods can moderate unemployment, but often exacerbates inflation. In the context of a potential Trump administration, factors like tax cuts and tariffs could lead to a more inflationary environment.
And neither the election outcome is not my biggest inflationary variable that I'm watching. Probably the single biggest variable that I'm watching is energy prices. It's pretty hard to get a really inflationary cycle when you have energy that's relatively well supplied. So there's been, a decent amount of offshore supply, and OPEC Plus has some degree of spare capacity. And so as long as you don't have war take out major oil facilities, we also have to see what Trump's going to do with Iran in terms of sanctions. So those are some of the big variables. The other big variable to watch, I think, is Chinese stimulus or lack thereof, because they're a more physical economy than the U.S. Their oil demand has been pretty muted lately for a variety of reasons. And they're the biggest trade partner with most countries in the world now. And so when they stimulate, they trickle out to a lot of other countries, just like the United States does. And so we have a very U.S. centric view often, and the U.S. obviously does matter quite a bit. It's one of the two biggest economies in the world. It has all these implications. But when I look at the Harris versus Trump election outcome, there's a lot of areas where I think that's important, but inflation, it wouldn't be in my top like two things that I'm monitoring. Generally, the energy situation, Chinese stimulus are kind of the top ones, followed then when we get down to election things, things like tariffs and things like who's going to stimulate more, that kind of stuff. Fiscal policy, monetary policy, and then just the current physical state of energy. So whose energy is disrupted or not, and what is kind of total global demand for energy, which the United States and China are both kind of the big levers. My base case in the next year or so is kind of choppy. I think we still have to work through some spare capacity. So if you don't get a war-related disruption, I think it could inch higher, but not be particularly explosive, and that can somewhat keep a lid on inflation. When I look out further into the late 2020s, that's when I'm a lot more bullish on energy. And for this reason, the way that I've been playing energy is to own the producers that are profitable at current prices. And so they're spinning off dividends, they're trading at fairly low valuations, they generally have pretty good balance sheets. And then you have that kind of embedded option in them that if energy does, for whatever reason, increase a lot, that just goes to their bottom line for the most part. And so it's, the base case is it chops along and is an income play. And then the bull case is you get upside. And generally, if you get an oil spike, that could put pressure on a lot of other assets. And so for diversification purposes, it really helps to own the things that benefit from an oil price spike should it occur. It could. I mean, so it'd be very different than most other models today. I think that the challenging thing about income tax is that you have to surveil everything, right? And that's kind of the one of the most negative things about it that doesn't get talked about enough is that the need to tax incomes means you basically have to surveil everyone if you want that enforced. Whereas other things are just inherently more visible. They're aimed at businesses, for example, rather than individuals. So I think that I generally comment on that less because I think it's very unlikely to pass, right? So when I look at a Harris and a Trump administration, I don't just look at what they're saying. I look at what are they gonna be able to do with a somewhat mixed Congress, or at least a Congress where the Senate has like a filibuster in place, things like that. So it kind of chops off the tails of what they want to do. So when Harris administration was talking about unrealized capital gains, I was like, okay, that would be very problematic, but what is the chance that actually goes through? And then when I see the Trump proposal about completely overhauling the type of taxes we do, I'm like that. I mean, that's a very tall order. So, I mean, if something were to start to materialize, I would have to factor that more into my analysis. But right now, it's more theory crafting because something of that scale, just from the point are at now, it'd be a tall order to get through Congress. I think it depends on the size, but generally what you would see is a combination of one, some of those costs being passed on to American consumers. Two, some pressure among those companies. Let's say it's China, for example, to redirect their products through others, so they can redirect it through Vietnam or redirect it through Mexico. Right? We've actually seen some of that in recent years. And this happened both in the oil market against sanctioned countries as well as with some of China's supply chains due to tariffs, is that they can redirect it through intermediaries that then makes it harder to identify and enforce those tariffs. So that's another factor. Generally speaking, when you look at the raw numbers, like the U.S. has a very big goods deficit, meaning that in terms of physical goods, we were running a very big trade deficit. And that's not something that can change very quickly, because even just down to energy infrastructure, part of why China is able to make so much is because they have like the biggest installed electricity base in the world. And a lot of that is coal burning. And a lot of other countries don't want that. They just, either their politicians or whoever doesn't want that type of power infrastructure. And so when you talk about the intended effects of the tariffs, one is you can get an income source out of it for the government, which you could, like we talked about, you could theoretically then replace other taxes. But two, they're trying to, in theory, reduce the trade deficit. The challenging thing is that because tariffs can impact quickly, but those supply chain rotations take years to do, um, that period tends to be fairly compared to the baseline of not doing that, tends to be somewhat inflationary because you can't just you can't, it's not like you just have a supplier ready to go in the US or ready to go in Mexico. It takes this kind of this shuffling of logistics, and that is basically a disruption which can go through a period of higher prices. But I think that the Fed policy is only partially looking at inflation. I think they're looking at other variables as well. Um, back when they were fighting inflation harder in the early 2023, when we had a regional bank crisis, they favored kind of saving the banking system over getting inflation down as quickly as they could. And now they're cutting interest rates while inflation is still above their target. It's down, but it's above their target. In addition, the Fed only has a handful of levers to deal with inflation. So what the Fed does with their interest rates is that they try to encourage more borrowing, like more credit creation, or they try to slow down credit creation, depending on if they're trying to stimulate or they're trying to fight inflation. And the problem is that in the current environment, bank lending is only a small percentage of money creation. The fiscal deficits are a bigger component of it. So back in the 70s, bank lending was a bigger aggregate amount than fiscal deficits, whereas now, they got bank lending to a very low level. Overall private credit growth, they successfully got it to a pretty low level, but that when they're running 7% of GDP deficits, there's still this like high watermark that's hard for the Fed to deal with. So, and they're not really interest rate sensitive. If interest rates go up, their deficits get even bigger. And they don't really cut spending based on the deficits. And if they were to have dysfunction in the treasury market, that you'd see the Fed step in and assist with it. So I think that that's one of the complicating things is that when the factors of inflation are outside of their control, they're not exclusively looking at inflation anymore, and instead they're looking at a holistic thing of inflation, banking system stability, treasury market stability, and so some of those things can lead them to be more dovish than you'd otherwise expect from the inflation data that they see. My base case is looking for at least 50 basis points of cuts, and we'll see what the data says to warrant more of that. I try not to look too far ahead because the market, they'll price in 7 cuts at one point, and then like a quarter later, they're pricing in 3. And so instead, what I'm really focusing on is like we're expecting mild cuts. The problem is that doesn't necessarily translate into borrowing costs going down. We saw, for example, with this 50 basis point cut, long end yields went up. And that is historically pretty unusual in modern history for them to cut rates by that much, and then like the 10-year treasury and mortgages go up. And that's close to what actually businesses and people are borrowing at. They're not borrowing at Fed funds. They're generally borrowing in the middle of the longer end of the curve. And their interest rates didn't really come down. We still have a partially inverted yield curve, which means that, again, short end cuts might not really affect borrowing costs. And an argument that I made earlier this year is that even when we get a fairly substantial cutting cycle, like let's say when we go down a total of like 150 basis points from the top, we're probably still not going to get a very big like refinancing cycle because so many people already locked in low long rate debts at even lower levels. So this will be the first cycle where we probably don't get a lower low in interest rates, either short end or long end. And that means that while it does help, say, small businesses, and it does help some of the unlucky people that took out mortgages at like the peak, it doesn't really result in this really big refinancing cycle. Same thing for investment grade corporations. A lot of them have locked in pretty long duration debt at low rates. And so interest rate cuts are not very impactful for them. Even some of the biggest names in the S&P 500, like Alphabet, for example, they have more cash than debt. And so actually lower interest rates, if anything, are mildly hurt them because if they're like they've locked in a little bit of a long-term fixed rate debt. They're holding a cash balance that earns interest. And if we cut interest rates, they get less interest income. And so we got this kind of like top heavy system that I think is not going to be very responsive to interest rate changes. So people will be focusing on, is it going to be, by X date, is it going to be 50 basis points of cuts? Is it going to be 75 basis points of cuts? Is it going to be 100? And while that matters, I would generally argue that it matters less than people expect because this is not a credit-driven cycle. It's a fiscal-driven cycle. And so the fiscal side is more impactful.
The policy landscape remains complex under potential administrations, with ambitious proposals like tax overhauls or capital gains reforms facing steep legislative challenges. Tariffs, while intended to reduce trade deficits and raise revenue, often lead to inflationary disruptions as supply chains adjust over years, not months. The Federal Reserve's influence on inflation is further complicated by the dominance of fiscal deficits over private credit growth. Despite anticipated rate cuts, their impact on borrowing costs and refinancing cycles remains muted due to structural changes, such as long-term low-rate debt and cash-heavy corporate balance sheets. Ultimately, fiscal policy, rather than monetary tweaks, is the primary driver in this cycle. As fiscal forces overshadow monetary levers, could this signify a paradigm shift in how economies navigate cycles, and are policymakers prepared for the implications? Don't forget to like and subscribe, and let's keep this bull run going.